Yes, and that is precisely right. A lot of the bullishness on uranium, it's the fundamental view, but it's also the administration's push for nuclear. We see substantial upside in uranium prices over the next 12 months. We see them going to $100 from around $78 at present, which is a bit more than 25% upside.
Hello and welcome to the Research at Citi podcast. I'm your host, Lucy Baldwin, Global Head of Research here at Citi. Today, I'm joined by Max Layton, Global Head of Commodities Research. So, Max, welcome to the podcast.
Thanks, Lucy. Great to be here.
In preparation for this podcast, Max, I was listening to the last one of these that we did, which was episode 10, I think, of the Research at Citi podcast, recorded last September. And back then, you were calling for substantially lower oil prices during 2025. And that's played out pretty nicely so far, despite, of course, some massive geopolitical headwinds that we've seen. And you were also very bullish on gold. You were targeting, I think, $3,000 an ounce during 2025. And here we are trading well north of 3,300 an ounce now. So it's up over 30%. What we'd want to focus on today, really, Max, is where do we go next, both for these two key commodities, but also any other commodities views that you and the team hold strongly across the whole complex, especially any of those that might be out of consensus, particularly when we think about the second half of this year and into 2026. So, Max, if it's okay with you, shall we start there?
Yes, that'd be great, Lucy. Thank you. So, look, in terms of the headlines, our top commodities views from here are across the complex. If we look across the entire complex, and we're covering over 20 commodities, our most bullish view, medium and long term, is aluminium. Second, that's ahead of uranium. We are, on the other hand, bearish on crude oil, but much less bearish than many of our competitors. In terms of the other top views, and certainly we're getting a lot of client discussion on this particular view, after having been bullish, as you mentioned, on gold over the last couple of years, very bullish on gold, we've switched that view, and in 2026, we're, I would say, cyclically bearish on gold towards the end of this year and into next year.
Okay, that's a really helpful overview. And let's start off, Max, if we can, please, with oil. Obviously, the oil markets have been a huge focus for investors this year. Is the sell-off done? That's a big question. I think a lot of people, given the amount of geopolitical tensions, maybe thought we would be at a higher level because of those geopolitical tensions. Obviously, some of those appear to have resolved themselves. So maybe we can talk a little bit about the geopolitics and what's going on. But then there's also a group of people that are much more focused, I think, in terms of the supply of oil that's going to be coming on, whether that's from OPEC or non-OPEC countries. And I think a lot of those people would perhaps ask you and the team why you aren't as bearish as some other banks are, given the surplus balances that many countries are running for the remainder of this year and into next year. So perhaps you can help us frame the supply side as well as where you see demand in the oil space, Max.
Of course. Look, overall, we do think there is more oil market weakness to come. We're trading around $68 at the moment, and we see the price getting down Brent basis to $60 to $65 through the second half of this year, and similar kind of price levels during 2026 as a whole. Those price forecasts are actually, from what we can tell, relatively high, although we are bearish in direction. The levels that we're forecasting are a bit higher than some of the other numbers. You've seen some market participants out there calling for $40, $50 Brent over the next 12 months. We're broadly in line with consensus, I would say, in the near term in terms of direction, but why are we a bit higher? I think it's a lot about how we see the production response function, sub $60 Brent. We think if you kind of step back and look at why this market has moved into surplus, it's because OPEC is bringing back the barrels. And why are they doing that? I mean, that is partly related to the fact the market can handle it, but also related to the geopolitics of the situation with Iran and with US-Saudi relations. So we are thinking sub 60. It's quite possible, if not likely, that the OPEC supply stops being brought back onto the market, that you get talk about US SPR builds, and you see a significant US supply response, which geopolitically may not be what is wanted. We don't think sub 60 is an equilibrium level for Brent prices. We think the equilibrium is around 60, 65. So we see a range of around $50 to $70. Sub 60 is towards the lower end and not sustainable in our view. And then up at 70, we think you'd get OPEC plus responding.
Got it. And it's quite an interesting backdrop, isn't it? Because I guess you've got the geopolitics on one hand. You have a number of people out there saying that had the situation with Iran escalated, had you had disruption in Strait of Hormuz, some people were calling for $110+ oil price. So you had that kind of tail risk scenario. And then to your point, on the other side of things, like kind of fundamentally absent the geopolitics, you've got some complicated supply factors. And I know a number of people looking for, as you say, I guess OPEC plus non-OPEC supply growth with, a variety of countries thinking about bringing more supply on. Just talk to us in a little bit more detail so we're clear on some of those dynamics, I guess, particularly for the OPEC countries and the reduction in supply that you might see if prices fall into the $50 a barrel type range, given where their cost base sits, being much lower than that. Talk to us about those dynamics, and obviously then, the revenue pressure that may or may not exist for some of those countries and the need to generate that revenue, Max.
Down in the 50s, at those kinds of levels, we think OPEC Plus returns to their prior strategy of managing inventories via supply adjustments. And that's been a strategy that OPEC Plus has been employing over much of the past 3 years. OPEC, they started returning barrels in part as geopolitical pressure and incentives shifted for them to do so. However, in the 50s, shale supply, as I mentioned, is likely to decline, something which President Trump is unlikely to be happy with, certainly over any sustained period, given his push for energy dominance. So his support for returning those barrels may reverse course at those kind of price levels. And also the revenue market share trade-off worsens as the price falls. So substantially raising inventories could increase the contango in the market, and that's unlikely to be wanted by OPEC as well.
Got it. And before we leave the subject of oil, Max, any final thoughts on, current weather dynamics, current demand set up globally, or any of the geopolitics for people to be mindful of?
Sure. So I would say the demand expectations it was significantly weakening over the last 6 to 12 months related to President Trump's tariff agenda, which is pretty momentous, significant, certainly biggest increase in US tariffs on some numbers in a century. And so there was very substantial concerns about downside risk to demand. Those seem to be dissipating, and certainly with the passing of the One Big Beautiful Bill Act, which is designed to drive an uptick in growth, particularly during next year. I would say demand growth and also given China's been able to shift its exports, at least in the short run, so that they haven't been overall impacted by the US trade situation, that the combination of these things have reduced the concerns about the demand, and people's demand growth expectations have picked up a little bit. I would say that helps to explain why the oil price has held up relatively well so far. And that's something that we expect to continue to support higher than expected levels in prices over the next 12 to 18 months as we head into the midterms. And President Trump is incentivized substantially to drive up US growth.
Got it. Very clear, Max. Thank you. Let's shift gears now to gold. Obviously, that's a commodity that's taking a huge amount of clients' mind share at the moment. Gold price has doubled in the last 3 years. You and the team have been bullish for certainly the last 2+ years. I know you're creating some waves in the market now by being more bearish on gold prices for 2026. I believe that's your base case. It's pretty out of consensus. Most people out there still seem to be pretty bullish given some of the central bank buying dynamics, which seems to be driving a lot of the market. And I'd love to get your thoughts on that. Before we start to think about 2026, what are you thinking nearer term in the second half of this year on gold?
Well, in the near term, we're pretty neutral on gold. We see it trading around these levels. We've got a pretty wide range on the forecast that we've been publishing and talking about for the last couple of months, which is around 3,100 to 3,500. Point price forecast is 3,300, which is roughly where we are today. And, it's likely to be supported at these very high levels by historical standards by a number of cyclical and structural factors that continue to be in gold's favor. These are pretty well known and pretty consensus cyclical and structural bullish factors, and we think they're priced. They're largely priced. I mean, to kind of put an exclamation point on that, we estimate that global spending on gold right now is about 0.5% of GDP. That's the highest in almost 50 years of data, even higher than during the second oil shock and gold boom in 1980. This gold price rally has also taken households' share of their net wealth that they hold in gold all the way up to 3%. Normally it's around 1.5% over the last 20 years or so. And that 3% is the highest in 50 years. So, a lot is in the market. Having said that, the main cyclical factor that should continue to support gold at high levels in the near term is concerns about the negative impact of US trade policy on US and global growth and also equities. In particular, people are concerned about a potential pickup in inflation in the US over the next 3 to 6 months as these tariffs flow through, and the deflationary impacts on ex-US economies. And, this concern has been the main driver of the move higher, these concerns in gold. And gold's moved higher from 2,600 to 3,300 over the year to date. So the impact of these tariffs is still highly uncertain. And how this plays out over the next 3 to 6 months is that we think clients will continue to hedge against downside risks to their wealth by still spending an extremely high amount of money, of global GDP, of their income, or out of their wealth in gold.
Got it. And it's interesting, Max, you say that you feel it's been driven very much by the sort of growth inflation dynamics and concerns around that, rather than the hot topic, which seems to have been central bank demand, central bank buying. A lot of clients really feel that that's been a big part of the bull thesis on gold. And I guess there was perhaps a step change since the start of the Russia-Ukraine war with respect to central bank diversification, central bank gold buying. Talk us through that and how material for the market that really is in terms of the absolute, the incremental, and how important you think that is to the forward from here.
I mean, there is no doubt that central bank demand for gold takes a very large amount of our clients and, in general, the gold market, anyone involved with the gold market, that particular dynamic is taking a very large amount of people's mind share. Our issue with that is it's factually true that central banks are buying dramatically more than they were 3 to 4 years ago pre-Russia-Ukraine. But our issue is that the amount of mind share it takes up is disproportionately large compared to the amount of mind share that central banks are actually absorbing. So the gold markets is almost, in terms of mine supply, it's almost about 4,000 tons a year. And that mine supply needs to be turned into something, whether it's jewelry or bars and coins. Turns out that central banks, they've been buying, and this includes the World Gold Council's unreported estimates of central bank buying. They've been buying about 1,000 tons of that 4,000 tons of mine supply. Roughly the same run rate, actually, for the entirety of the last 3 years. And, we expect they'll continue to buy around that run rate for at least the next 2 to 3 years. And this has been a really important kind of foundation for the gold bull market and was a big part of why gold went from $1,600 to $1,800 up to around $2,500, $2,600 through the third quarter of last year. But it's not really, it hasn't changed at all in terms of the volume of buying over the last 3 to 6 months. From what we can see, it's been roughly consistent, if anything, slightly less. In our opinion, hasn't been the driver of the delta in prices for this last leg higher, this last $600, $700 higher.
Interesting. And it doesn't sound as though it's going to be a driver for your 2026 view. So Max, tell us about the bear call for later this year and into next year.
Yeah, so the bear view is very much focused on the cyclical element of this bull market in gold and not the structural bull stories. The structural bull stories, we are in agreement with the bulls on the structural side, whether it's central bank demand or whether it's potential insurance company demand from Asia, or whether it is about concerns about the US budget deficit, US debt to GDP, US interest burden, those kind of medium, long term and things that have been part of the bull market over the last 3 to 4 years. We don't see them changing. And in fact, one day, they particularly 2027 and beyond, we think that those could even become dominant factors again, and could see, another gold bull market based on those factors kind of flaring up, particularly the deficit concerns. But the bearish call about 2026 it's focused on two things, really. We have this view that the current elevated fears around US growth and the downside around US growth specifically, that they're going to dissipate over the next 6 to 18 months. Not in the near term, and that's why we're neutral, but heading into the midterms, President Trump wants, needs, and will persist in his drive for strengthening US growth. If tariffs and the One Big Beautiful Bill Act and deregulation don't work to drive up US growth, President Trump, he's shown that he can vary his execution to achieve his goals, and he will change things up. For example, he may raise funds through kind of new initiatives, whether that's gold card or potentially revaluing the gold reserve, or it could be things like even reducing the tariffs. There's a number of different ways that if his agenda doesn't work, there's a number of other ways that he can move things. Of course, the One Big Beautiful Bill Act is a big part of his agenda, and that's just passed. And the way it's designed is most of the bullish things for US growth happen in 2026 or this year or 2026, but almost all of the bullish growth stuff happens in 2026. And then the spending cuts really don't kick in until 2027, 2028. The other big reason why we think some of this cyclical fear and growth downside dissipates is that we just don't see a US bond vigilante moment. And the reason is because the tariffs pay for the delta in this One Big Beautiful Bill Act.
Yeah, obviously lots of debate on some of those points in the market at the moment. And I guess just to round this out, on this concept of maybe US rates falling, obviously a lot of people wondering what the Fed is going to do, whether they can cut, will cut, and when that may be, and how the labour market looks, etc. I know this has been another factor in some of your discussions, this kind of concept that US rates falling can be bearish for gold. Just wrap it up by telling us what you think's going on here right now.
Yeah, of course. I mean, we've spent much of the last 3 years talking about how a large part of the gold bull market has been essentially investors hedging against downside risk to US growth as a result of high interest rates. So interest rates, both nominal and real, in the US went up dramatically in 2022. They've been very high for 3 years, and they've been at around 15 to 20-year highs. And people have been concerned that those high rates would result in higher debt service burden, slower US growth, potential recession, and they've been hedging those downside risks by buying gold. So it is our base case view that a move from restrictive policy, where we currently are, down towards neutral, which is the house base case by the middle of next year, that will actually improve US growth sentiment and therefore result in less investment demand in gold. Now, it's super controversial because for much of the last 25 years, falling US interest rates has been bullish gold because it's been associated with weaker US growth sentiment. Our baseline view is for a Goldilocks scenario where the Fed is cutting to get towards neutral to support growth, and that growth is close to fine, essentially going from restrictive to neutral, and therefore lower rates, bearish for gold over the next 12, 18 months.
Got it. And then when you think about the dollar, that's obviously a big move this year, the dollar weakness. How does that play into your view on gold, and what does that look like from here and also more broadly across commodities?
Sure. The house view is lower dollar near term over the next 6 months or so, modestly lower. And then in 2026, modestly bullish. And that's pretty consistent with this kind of slower US growth, concern about inflation, concern about still high interest rates continuing. And then it's also about the stronger US growth profile that we have in 2026 and the Big Beautiful Bill Act passing through in terms of stronger US growth, which means at least our house view is stronger dollar. And that's pretty consistent with the gold view. It's also really consistent with our, I mentioned at the start, our medium to long-term bullish view on aluminium. We also have a medium to long-term bullish view on copper, although we don't think this is the best time to express that view. So the other interesting bit is longer term. There is, on the one hand, there's big concerns about the US budget deficit, but on the other hand, this administration has talked a lot about how if it can improve growth, then the budget can look a lot better, the balance over the medium term. If that doesn't happen, then obviously a weaker dollar over the medium long term due to US budget issues would be a super bullish scenario for many commodities. But of course, there is the prospect of AI related productivity, stronger US growth related to this budget that may mean that doesn't happen.
Yeah, and the other standout view, Max, that you just mentioned there in that is obviously aluminium. It's a super interesting market. I know you told me a while ago that aluminium is power in the form of metal, with global power demand set to boom, as you say, on the back of a whole host of things, AI included. Where are these aluminium smelters going to be getting that power from to make the aluminium, Max, to your mind as we go forward from here? What's going on in that market?
Well, that is the question. It's very difficult to find where they're going to get the power. And even where there is power supply growth, the demand for that from future-facing sectors, whether it's data centers or manufacturing capacity, building robots and drones, focus in particular on China here, where the capex on data centers has increased dramatically, about 100% year on year in the first quarter of this year. Robot output is up 60% year on year. China had been essentially driving almost all supply growth in aluminium over the last 20 years. And this is why this commodity's performed so badly. The last 5 months of reported data in China has been flat, and China has essentially reached its capacity cap, its capacity limit on aluminium. So this country that has been, driving supply growth and kind of keeping prices in check in this market for 20 years has now reached full capacity. It's not obvious at all where the supply growth comes from. And this is a market that has very strong demand growth driven by those future-facing sectors. There's a lot of aluminium in the power infrastructure, in the manufacturing facilities of the plants, in the data centers themselves, whether it's for cooling or not. It's about 25 kilos in each humanoid robot. And also aluminium is, generally tied to global growth. So an improvement in global growth over the next 12 to 24 months together with these sectors. And you're looking at very large sequential deficits in this market, 26, 27, 28. There's practically no supply growth, a little bit out of Indonesia, about 500,000-600,000 tons a year, compared to demand growth, which is in the vicinity, we think, are going to be 3 to 4 million tons per year.
Wow, got it. So aluminium, absolutely the go-to place to play the big themes, AI, data centers, robots, drones in the military space, etc., in commodities by the sounds of it, Max. And presume your bullish view that you've got on uranium too is related to power demand growth. Be interested to hear your thoughts on that. And also what your view is on US gas on the back of power demand growth prospects too.
Yes, and that is precisely right. A lot of the bullishness on uranium, it's the fundamental view, but it's also the administration's push for nuclear. We see substantial upside in uranium prices over the next 12 months. We see them going to $100 from around $78 at present, which is a bit more than 25% upside. We've been very bullish on uranium over the last 6 to 12 months. The enrichment market is still quite tight. Russian enrichment is not really reaching the Western enrichment, and so they're having to use a lot more natural uranium to make the same amount of final product. And on the gas side, prices come off quite a bit on Henry Hub down to the low $3, and these are the kinds of levels, this great timing for this call actually, because these are the kinds of levels that we think clients and investors should start to think about taking some exposure.
Got it. And I'm a little bit surprised, Max, you haven't been telling us that you're bullish on copper, maybe at least longer term, because I think I'm used to normally hearing and seeing that given the role copper has in the power sector, with the outlook for data centers, AI, etc., a lot of people would be perhaps choosing to be long copper at this point. How do you feel about that as a sort of wrap-up call on the thematics of data centers, power, AI, etc.?
Yes, it's because copper's got some idiosyncratic downside over the next 3 months or so. And that idiosyncratic downside is related to the way the Section 232 process on copper that President Trump and the USTR is running has been handled. Essentially, they're running a process. So the market is assuming that there is some probability that there's going to be a large tariff on copper. And so traders around the world are incentivized to ship copper units into the US, which is tightening the ex-US market. It's tightening it very substantially. And that has, in our view, driven the copper price up around $1,000 higher than its fair value. So once this Section 232 results come back, no matter what the results are, and we think those results will come over the next 1 to 2 months, and then the copper price, we think, will return closer to fair value, around high $8,000, $9,000 a ton, around those kinds of levels. And at that point, we think that could be an opportunity to take exposure to copper for the longer term, for all the reasons you mentioned.
Max, fantastic. Thank you. This has been a great conversation and broad and wide ranging. It's been fantastic getting your thoughts on what's going on in the commodity space.
Thanks, Lucy.
This episode of Research at Citi was recorded on Monday, July the 7th, 2025. I'm your host, Lucy Baldwin.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyrights 2025 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.